Hey folks, Dan Frio here with your market update for December 19th, 2024. So the aftermath of the Federal Reserve rate cuts is hitting once again. So back in September 18th, when the Federal Reserve cut rates, the biggest cut they had in a long time by 50 basis points, rates went from about 6% to 7% in a matter of a couple weeks. So the markets kind of descended a little bit from there, and then the Federal Reserve cut again yesterday, and this is what happened when the Fed cut again. So we're back over 7%. So what is going on in the markets right now? So I got some content I want to give you guys that just came out this morning. Some jobs report numbers came out, and then tomorrow we have more inflationary numbers. We also had the GDP come out today, and a lot of these numbers are looking a little bit better than expected. So let's get over to today's economic calendar to see what's going on. So right through here, we had the GDP come in this morning, and it is at 3.1. They expected it to be at 2.8. So the economy is stronger than anticipated. Initial jobless claims came tumbling down. The last reading was 242,000. It's now 220. So that's what's happening right through there. And then the Philly Fed manufacturing, that's plummeting right now. Was down -5. Now it's down 16. So this is what we're seeing right through here. So the economy in general, right through these numbers are telling us it's a pretty darn good economy. So what in the world's going on? Well, it's the inflation numbers. Okay, inflation's what's freaking out the Fed right now. They said they tackled it, about 6-8 months ago, and then the inflation rates just stopped. They didn't move. So last year about this time, the inflation number was about 2.9, and right now the inflation number is still about 2.8 or 2.9. So there's really not much progress from the Federal Reserve over the last year on inflation, and that's the concern right now. So let's get over the jobs market right now. Jobs claims after Thanksgiving pop gave some vibes that the U.S. economy is doing much better right now. Then you go over to here, GDP growth was revised up 3.1% from 2.8. So it's saying the economy's good, labor markets are good, payrolls, and you might feel like you're getting cheated on your payroll, but if you move jobs over the last year, you got a pay increase of about 7%. If you didn't move jobs, most people got a pay raise of about 4 to 5%. So you're outrunning inflation right now, but it's still ugly out there, folks. So let's get over to the broader markets that we're seeing right through here. The MBS market right now is down 11 ticks. It keeps just gradually going down and down and down. Not really quite sure why, because the data coming in today is pretty good. But let's go to former Fed official. He has this is a pretty long conversation, but he has a pretty candid interview with CNBC, kind of talking about what the Fed's progress has been and what their goals are. So let's take this, and then when we come back, I'm going to show you the CME Fed Watch tool. It's giving us it's not a good outlook for rate cuts in the future, but guys, we don't know. And every time the Federal Reserve cuts rates anyways, mortgage rates go skyrocketing. So let's get his take on the markets, and when we come back, I'm going to show you how the equity markets are and the crypto markets are. And then I got a little bit of a surprise for you guys today. We're going to start a new spinoff of the channel a little bit, and we're going to start talking to realtors, and I have realtors on here so you can ask them questions directly, so you can get some understanding on how realtors work and what they do and what advice they could give you. So first off, let's get to the former Fed official, see what he has to take on the markets, and then we'll be right back.
For more on the economy and the Fed's latest rate cut and messaging, let's bring in Richard Clarida, former Fed vice chairman and now global economic advisor at PIMCO. So we were talking, it was 3 minutes ago. I think I can remember. Do you remember what we were talking about? Let's just recount what I asked you when you sat down. First thing I said was, is it possible that the Fed hikes next year? And you said probably not. Yeah. And then I said, do you think the risks are asymmetric? In other words, I'm asking whether both mandates are equally important right now. And
Okay, so first off, we need to know what the two mandates are, what he's talking about. So he's talking about the Federal Reserve. The Federal Reserve was created for basically two reasons. One was to keep employment at full employment, and the other one was to keep prices in check, aka inflation. So what they're asking is, are they working on both mandates, the unemployment rates and the inflation rates, or are they just kind of focused in on one? Because about 6 months ago, they came in and said, well, inflation's tackled. Now our concern is the jobs report. So now it seems like it's kind of flipping backwards, because the jobs market's looking pretty okay right now. But you get my point. Let's just get back to the interview.
You started to tell me that that the inflation, the dollar stability side of things is more important to what the Fed should be doing right now. And then I said, well, then why are we cutting?
Okay, well, I do think the risks to inflation are to the upside, and I think the committee and the chair acknowledged that yesterday. I think the case for cuts going into September was the data was cooperating and they felt the policy was restrictive. I think the case for a cut yesterday was a close call. Indeed, we had President Hammack dissenting, and we had the unusual situation, Joe, where three other officials, presumably presidents, also indicated that they didn't support the cut through their dots. So I think it was a close call. I do welcome the fact that the committee, this first phase of recalibration appears to be over, and they're now really talking, and I believe them, that they're going to be very data dependent about the timing and extent of future cuts, and I applaud that.
It's just, Richard, the whole nebulous idea of restrictive versus neutral. Just reading an article today, it basically...
Okay, so this is the dot plot we were talking about yesterday as well. So you can see through here, 2024, the dot plot came in right in line with what they were expecting, 4.25 on that. So now what the Federal Reserve is telling us that the 2025 dot plot is saying they're expecting the federal funds rate to be at 3.75. Basically not much different from where it is now. So is this one cut, two cuts? We're going to see what the future lies in Fed rate cuts here shortly. But let's continue with his take.
He says that the way the Fed decides what is neutral and what is restrictive is based on the economy and conditions when they look around and what they see.
Yeah.
And that's why I would have thought I would have come to a different conclusion given the stock market, the GDP number we just posted, Bitcoin, we've talked about the banana on the wall, all the things that we see didn't appear that we were in restrictive territory and didn't seem like an environment where you would have cut 100 basis points.
Well, my comment on that is very consistent with what you said. It's a complex economy, financial markets. Financial conditions broadly defined, including the Fed's own index, are easier than they were before the first hike. They've eased a lot. Higher stock prices and tight credit spreads and all the rest. The Fed also, of course, focuses on the rate they control, which is the interest rate. And so they judge, and I use that word precisely, they judge that policy is restrictive. But they also acknowledge on the committee there's a range of views about that. And so that's why I think it is appropriate as we look into 25 for them to move away from a model-based, we judge we're restrictive, to more of a data-based, are we getting that progress on inflation? Quite frankly, a year ago, December of 2023, the year-over-year PCE inflation rate was 2.9, and that was good news. It was below 3 for the first time in 3 years. It's going to come in this year at either 2.8 or 2.9. So by that metric, actually very little progress on their preferred measure. So they're forecasting additional progress next year, but right now that's a forecast. And so I think just data dependence here is the way to go.
I'm old enough to remember a bunch of times when the Fed had to take back things they had done.
Yeah.
And I just hope that this time, that one of these times in the middle of doing something like this, we're pointing out that we may not know that we're in the midst of a policy mistake. We may be in the midst, like when we were at 0 for too long.
Yeah.
We really talk about, did we know we were in the middle of a policy mistake? Could we know right now that we shouldn't be easing?
It would be difficult given, I think, that the labor market data, and Steve raised this point, I think if you are looking for evidence that confirms the wisdom of some of the cuts, is the labor market is slowing, particularly private employment. The Fed does have employment as part of the mandate. But because of those long and variable lags, Joe, typically you don't always know in the midst of a policy mistake until sometime into it. So I couldn't rule that out.
I mean, we could be cutting like crazy in a year because the labor market weakened so much.
Yeah.
I just want to try this math on.
So this is what they're saying. So so I hate when they come out with 2026 projections, 2027 projections. They don't even know what's going to happen at the next meeting or the next two meetings from now. And they're saying, okay, is the Federal Reserve holding off? So what happened previously, back when inflation spiked back a couple of years ago, is the Federal Reserve kept basically rates at 0. And then they're like, well, we're going to let inflation get a little bit hotter than expected and so forth. That's what they're talking about. So they didn't react at that time, and inflation went all the way to 9%. And then they're like, whoa, now it's time to cut. So now they start cutting. They cut already 100 basis points, but they're saying, well, the labor market's still, okay and whatever. But if you see a deterioration in the labor market, then the Federal Reserve will be behind the curve, or you see the markets collapsing in other ways, then the Federal Reserve's behind the curve. That's what they're talking about. And then are they going to come in and have to massively start cutting? So it's like, instead of going gradually, up and down, it's like boom, boom. So hope you get that point. I hope I don't have a popper thing on my mic, so I hope they didn't blow out anybody's ears there. So let's get back to it.
And you, Joe, and some clarity from Richard Clarida here.
Clarity from
Because nobody else can do it like he does. Joe, if you had a 7% inflation rate and a 5.3 funds rate, and that 7% comes down to 2.5 to 3, you need something less than the 5.3. Right?
No, not necessarily. I'd like to save my powder in case, because the economy hasn't.
Keep slamming down.
No, it's not. Where do you see evidence of slamming?
Well, that's a good point, because the thing I want to ask former Vice Chair.
Former Vice Chair, yes.
You're still a Vice Chair to me.
Okay.
Isn't some of the relaxation in the financial conditions right now a direct result of 1 year ago or so when the Fed pivoted?
Yeah.
So that's what you have in the economy right now. If the Fed had not pivoted, you would not have these financial conditions.
Sure. Yeah.
So therefore, it was sort of a result of that, or maybe the right thing to do.
The other thing I will point out, though, is the disinflation from 6 down to 2.5 is remarkable. The fact that we avoided a recession is welcome and unusual. I'll also say this, and the chair himself towards the end emphasized it yesterday. The U.S. economy is quite remarkable right now. We have the highest productivity growth in the world. We have an innovative economy. We're energy independent. Household balance sheets are in great shape. So we keep focusing on things that potentially can go wrong. And I think even the Fed is disappointed that progress on inflation appears to have stalled. But the fundamentals are quite good. So part of the buoyancy and risk appetite is, where would you rather invest right now, the U.S. or almost any other country in the world? So I think that's part of it as well.
Great interview. I hope you guys felt the same way. So let's get over to the bond market. You saw this ticking as he was talking. This is live at, what time is it? About, let's see, I'll give you my time. 9 o'clock in the morning. So that's what we're seeing through here. So again, what they're saying about the economy, jobless claims subside after Thanksgiving pop and gives vibes for revive in the U.S. economy. GDP is at 3.1 now from 2.8. So it's not a bad economy, folks. Go over to the CME FedWatch tool now. They're saying they don't know when they're going to cut again. If you look through the CME FedWatch tool, it looks maybe till May or June of next year. Let's just throw this out the window. They don't know what's going to go on at the next couple indices that come back in. The employment claims, are going to be more and more of those coming out and so forth. So if there's any big pivot in any of these, it's going to be market reactions, and the Federal Reserve will basically change on a dime. So that's what we're seeing right through there. Let's see what the equity markets are doing right now. So the Dow Jones is coming back it dropped 1,100 points yesterday, picked back up 300 already this morning. There's a lot of money on the sideline, guys. I talked to a lot of investors. We have an investment firm actually in the bank here, and I talked to them as well. There's a lot of cash on the sidelines. So every time the market kind of pops down, you'll see people the next day jumping back in, trying to bargain hunt. So basically it's green all the way across the board. We got Dow Jones up, S&P up, NASDAQ up. Oil is up at 71. I don't like that at all, but we'll focus in on that. And the 10-year Treasury, again, that is spiking as well. Let's get back to cryptocurrency. That's probably up. No, it's down today, just over 100,000. This was about 108,000 yesterday or the day before. So that's what we're seeing in the markets right now. November home sales surge more than expected, boosted by lower mortgage rates. Well, that's going to change here shortly. So here's where we're going to pivot to, folks. If you're a realtor out there, I'd love for you to contact me. I'll give you all my information at the end of this video. If you're a consumer out there, here's what our goal is to you guys in 2025. My main goal now is we want to work with realtors. We want to work with you borrowers. But the rate update kind of theme that we have, I'm going to kind of throw that out the window a little bit. Here's what we're going to focus in on. And here's the reason why I'm doing this. I'll be basically candid. disappointed. We have a lot of people, because of my website and everything's called the rate update. They keep asking about rates and what should they do, and then what lender should we use? Well, folks, I'm actually a mortgage loan officer, okay? So I work at ServBank. ServBank's the 10th largest mortgage servicer in the whole country. We're also a huge broker. So by working with us, you're going to have one application, one credit report, and you're going to just work with my team. What we're working on right now is a streamlined process to get people closed within 10 days. 10 days. So we're going to throw out the rates. We do have still fantastic rates, but our goal now is to work with you and the realtors to get you a solid approval, get you a solid offer. Basically, you're paying cash for the home, because we're going to put you in a position where you can actually walk in and give an offer and say, you know what, I can close within 10 days. So that's what we're working on behind the scenes. But I need you guys out there. If you're a realtor, please email me. I'll give you my information here in a second, but visit us at therateupdate.com, folks. If you're out there looking to buy that first house, first investment property, maybe you're looking to refinance. Maybe you're an investor. We're doing a lot of DSCR loans right now. If you don't know what I mean by that, it's a program for investors that you can qualify to buy that investment property with just rents alone. I don't need your tax returns. I don't need your pay stubs. I don't need anything. It's just if the house is self-sufficient, I can probably get you into that house. So these are just offers or programs that we offer to you. To find out more, please reach out to us. Okay, go to therateupdate.com. You can put in your application right through here. I highly suggest schedule a consultation, because we want to know what you're looking to do. What are you looking to do? I'm sure you want to talk to us to say, is it a good fit? Do we have the programs? Do we have this? Do we have that? I can assure you, no matter what state you're in, we can help you. We're licensed in all 50 states. If there's a program out there, I most likely have it, because we're set up with ServBank, again, the 10th largest mortgage servicer in the whole country. Plus, I'll just skim it down. 40 other lenders we can use to help you guys navigate this mortgage market. So check it out. If you're looking to refinance down the road, check out our new refinance rate watch tool that we have. I'm going to scroll my head over a little bit right through here. You can click this. And what it'll do is you can put in your information, tell me what rate you want to refinance at. And when that rate hits it, I'll get you on the phone. We'll talk about it, see how quick we can get you closed, what the rate is and the fees are. We'll get you through that process lickety split. So let's get over down through here now. I'm going to show you how to contact us directly. So if you go to the bottom of the website, you're going to find our 800 number as well as my email address. So give us a call at 844-775-5626. Or if you're a realtor out there, I need you to reach out to us. So don't call. Email me and I'll schedule an appointment. We can do a one-on-one, see if it's a good fit for you and me. And then we'll get you on future episodes of a real estate roundtable that we're going to start in January, getting realtors involved to help you guys navigate home buying. Thanks for watching, folks. Have a great afternoon. I'll be back here later this evening with the closing bell. Take care. Bye-bye.